Welcome to your closing bell for this week. Jason Jacoby, the Mr. Tan guy, Mark Boyer here.
Summer, man. It's summer.
I know, you look great. I love
I
this.
just
I'm
look
digging the
tanner because of
tan.
my white hair. That's why. White hair makes you look tan.
It's perfect. You look great. There wasn't a great week for the markets.
No.
We had some big news that kind of started this ball downhill a little bit. We actually recovered most of those losses that we experienced in that day, but again, still a down week for the markets. So let's kind of dive into that a little bit. Fitch, one of the three biggest credit rating agencies, you got Standard & Poor's, Fitch, and Moody's, lowered its credit rating for the United States Treasuries, right?
Yes.
For their credit worthiness from AAA to AA plus. Now, going forward, what does that mean? Because the last time this happened, 2011, S&P did it first, and markets tanked over 5% that day, even more so depending on the indices. Now, the U.S. debt at that time was around $13 trillion. We're over triple that now, 36 trillion about right now. So what does this mean?
Yeah. That means we owe a whole lot of money
True.
in interest. So the Fed's, the Fitch is trying to just make sure they're ahead of the curve and they're not getting surprised in regards to the concern they have in regards to government spending, and we're just spending more than we're taking in, and we're not being, it's like I can't do that, you can't do that at home. None of us can spend more money than we bring in, or else at some point you pay the piper.
Yep.
Right? I mean, so government's no different. The only difference is that the government can print more money, and so. That's the problem, and never was meant to be this way, but they print more money than they can. But they can't do that because that's inflation. So we're in this quandary a little bit.
Yeah,
so where they're trying to reduce printing of money, quantitative tightening, raising rates in order to slow down demand. And so you find yourself now with this hit, kind of surprised the market. Markets responded pretty negatively on Wednesday, and then. Bond market especially, I think, got surprised. So the interest rates went up across all durations on that day, because it makes sense if your credit rating gets lowered and
It's riskier,
more
right?
riskier, then you're going to, as an investor, you want to demand a higher interest rate. So that's why that happened.
That's a
and
good
so
point.
now the market, markets dropped and the rates went up, bond values went down. And so, it kind of got a little bit bounced today, but they're going to try to figure out their equilibrium at this moment. We'll see what happens there. But really, all of that, honestly, I mean, based on where the markets have been, I felt pretty confident that the market handled it pretty well.
Yeah.
And, with earnings and what's going on and different things, we'll see how this next week plays out. But we got some key averages that we hope the market holds for this current, bull market.
And you brought that up, kind of, you were excited, or not excited, but at least satisfied with how the market reacted to this news. I mean, it could have been a lot worse.
Oh, yeah.
Obviously, it wasn't the first time this has happened, so it was kind of like, oh, this is kind of, we knew this already. But obviously, there's different ways to think about paying for this. How do we pay for the debt? You can raise taxes. You could lower taxes to stimulate the economy, cut the red tape, increase GDP, growth. And that would technically be the way to do it. Ease the supply side to increase more supply, to cover the demand, which actually lowers inflation too, puts more money in people's pockets and spending more money.
Yeah.
You could obviously not higher tax brackets, but tax revenues to kind of cover the debt. So again, but we got to get the house in order. But one thing I really want to touch on, because one thing that we've talked about, which we predicted last year, not that we're always right, but we talked about a rolling recession. So I want you to touch on this a little bit, because we had seen something from one of the top managers here. Yeah. They're talking about this could be the rolling recession. You have different sectors that are in contractionary territory, like manufacturing. You have services that's still in expansionary. So you got a tale of two economies a little bit. So
we were kind of laughing because, man, we were on top of this, I'm not bragging, but we'll brag a little bit. And we talked about that a while back, about this maybe as a rolling recession where you get various quarters. I was thinking of more of quarterly. You get like last year we got two negative quarters, and so sort of, then we kind of went up, and maybe we get that again. But it was interesting, this major manager just as sort of, had been waiting like all of us for this recession, and they've come to the conclusion that the rolling recession has been in specific industries along the way.
So good. That's so true.
Semiconductors, oil, went through a low point and now it's coming up.
Yep.
Semis, same. Housing last year kind of tanked, and now all of a sudden we're seeing growth again. So you have these different specific industries or whatever that are going through recessionary type,
Good point.
economies and specific to them,
Yeah.
and yet the consumer is staying fairly strong through it all. So all that to say is that we talked about that, this might be different. We just hope that the Fed doesn't continue to over tighten and cause problems that they don't need to cause. So that'll be, we'll see what happens here with if they continue to pause, like they do, we won't do anything probably till September now, and if they come back and numbers and things that come out seem to be more positive, maybe they'll continue to pause. That'll be really positive
great
for the fixed income markets again too, and it could be the stock market. So,
Yeah, absolutely. Well,
anyway.
you definitely hit some nails in the head there, and some great points. So we'll be back with you next week. Stay tuned for updated developments. This is this week's Closing Bell. See you next time.
Thank you guys.